Welcome to the Deep Dive. Today, we are cracking open the Q2 fiscal year 2026 earnings call for PodcastOne, ticker symbol PODC.
Yep.
This was an intraday call that came right after a really positive press release, and it set the stage for a pretty dramatic day in the market.
Exactly. And with a microcap like PodcastOne, a company that bills itself as this leading pure play podcasting platform, you always have to be a little wary of the narrative.
Right, the story they're telling.
The story. They have been pushing this AI and ad tech integration angle relentlessly. So our mission today is to figure out if all that tech hype is, finally translating into real, measurable operating leverage.
That's the key, right?
Right.
The moment they stop being just a story stock and start proving they're a scaled operator.
That's the whole game.
Okay, so that distinction, story versus operation, is crucial. Let's jump right into the financial snapshot that seemed to signal this shift. It was a clear beat, and the numbers drove that market movement almost instantly.
It was unambiguous. So, starting at the bottom line, they delivered a nice earnings surprise. GAAP EPS came in at -4 cents.
Okay.
Now, that's a 1 cent beat against the consensus of -5 cents. And it's a meaningful improvement from the -7 cents they saw in the same quarter last year. It shows costs are being managed.
But the revenue figure, that's where you really see the acceleration.
Oh,
right?
Absolutely. They reported $15.2 million for the quarter. And that wasn't just a slight beat. It crushed the consensus estimate of $14.26 million.
So we're talking about almost a 6% beat.
A 6% beat and an incredibly robust 22% year-over-year revenue growth. For a content platform, in a recovering ad market, 22% growth is a massive green flag.
It's huge.
But here it is. Here's the most pivotal financial detail, the one that really tells that operating leverage story. Adjusted EBITDA. It swung massively into the positive. They reported $1.1 million this quarter.
Wow. And what was it before?
Well, you have to compare that to the $0.4 million loss they posted in the prior year quarter.
So that's a $1.5 million turnaround.
In just 12 months. It's a huge swing, moving them from burning cash to actually generating internal resources. This really demonstrates the operational inflection point the market has been waiting for.
That shift from loss to, self-funding is what validates that whole technology investment thesis. But let's look under the hood. If adjusted EBITDA looks good, what does the GAAP picture look like? And how strong is the balance sheet that's supporting all this?
Good question, because the GAAP picture is also improving, which is critical. The GAAP net loss narrowed substantially to just under $1 million, $0.98 million.
Okay, so their net margin is in the negative mid-single digit range?
Exactly. Which is so much better than the $1.67 million loss from a year ago. The operating loss narrowed right along with it. So look, they haven't hit full GAAP profitability yet, but all the lines are definitely converging in the right direction.
And the capital structure. For a growth company pivoting this hard into tech, you often see a lot of debt.
They are exceedingly disciplined on that front. They finished the quarter with zero debt.
Zero.
Which in the current environment gives them massive flexibility. We do have to note, though, the cash position was, let's say, modest. It's sitting around $2.7 to $2.8 million.
So that's a constraint.
It is, and management acknowledged it. It limits their ability to do aggressive, debt-free M&A. But that zero debt offset means they aren't bleeding cash just to service loans.
So they have the financial discipline, but what about the engine generating the revenue? Is the content network growing?
It is. They're maintaining competitive scale. The network now has about 210 shows. They brought on 17 new podcasts so far this year.
Yeah.
But the metric that really validates their quality and reach is their standing as a PodTrack top 10 publisher.
They've held that for a while now.
For a full 12 consecutive months. And that's proof, that they aren't just relying on one-off viral hits. They have sustained large-scale audience engagement.
Okay, let's transition to the core of the monetization story here, the ad tech stack. Management claims this is the reason for all the leverage. Podroll, their dynamic ad marketplace, seems to be where the magic is happening.
Podroll is just exploding. And this is where that AI investment shows a tangible ROI. Podroll revenue grew by a massive 71% year over year.
71%.
71. And management was, you could tell, very eager to highlight that this marketplace is now officially a 7-figure annualized business. That kind of growth in a proprietary, high-margin revenue stream is a fundamental game changer for their model.
It absolutely is.
Yeah.
And how does that marketplace interact with, the broader programmatic world? Are they just selling on their own platform?
No, they're diversifying. Their programmatic revenue, combined with their critical Amazon Art19 revenue channel, showed strong sequential growth. It was up 14% quarter over quarter.
So the tech is working even through third parties.
Exactly. It confirms that the technology they're using to sell their inventory is highly effective. They're optimizing pricing across every channel.
You mentioned Amazon. Management called out two really big partnership deals as key leverage points.
They are critical. First, that collaboration with Amazon and Art19 is scaling very quickly. It's heading toward a $20 million plus annual run rate,
Which is a huge piece of their total revenue.
a substantial piece of guaranteed forward revenue. And second, they referenced a collaboration with a Fortune 250 streaming partner that's running at an annualized rate of over $26 million. These aren't just small deals. They effectively pre-sell inventory at scale.
Okay, so this brings us to that core strategic narrative, the AI-enhanced content flywheel. They say they have this integrated stack that makes content cheaper to produce and easier to monetize. What are the specific tools they're actually using?
Right. This is where we move past the buzzwords. Their tech focuses on three distinct areas. First, there's Flightpath.
Flightpath.
Think of Flightpath as like a predictive stock analyst for their ad slots.
Yeah.
It uses machine learning to forecast listener demand and optimize ad placement in real time to, maximize profit on every single impression.
So it's not just about targeting the right listener. It's about getting the absolute best price for that targeting. What about the operations side?
That's where Booster comes in. Booster is their ad ops and recommendation engine. So if Flightpath figures out the price, Booster handles all the logistics. It matches inventory with buyer demand and scales ad proposals without needing a whole army of people doing it manually.
And that's the operating leverage. Selling more, faster, with less overhead.
That's it. And then there's the content side where they're shifting hard to video.
Right. How does their tech enable that without costs just ballooning?
That's the third tool, Opus Pro. Opus Pro is like a digital short order cook. It takes their long-form video podcasts and just instantly chops them up into short, digestible, platform-specific clips.
Right. One YouTube video becomes 15 TikToks.
Exactly. 1 in, 15 out. And this is crucial because, as management noted, consumption is shifting to video across YouTube, Spotify, TikTok, Rumble, everywhere. Opus Pro lets them meet that demand on multiple platforms at a minimal extra cost.
That ability to repurpose content so cheaply? That's a huge advantage. It really speaks to the efficiency of the whole creator acquisition model they've built.
Absolutely. The platform is becoming a destination. I mean, you saw huge guests in Q2 like Jay Leno, Bill O'Reilly, Charlie Sheen, but it's the strategic content moves that really matter.
Like the BuzzFeed deal.
The BuzzFeed deal for Phone a Fangirl, which broadens their Gen Z reach. And the acquisition of Beach Too Sandy, Water Too Wet wasn't just about buying listens. It was about buying a hyper-engaged niche community that demands high ad rates.
So with those incredibly strong Q2 results and the monetization levers clearly working, let's look forward. What did management actually project for the rest of fiscal 2026? This is where the rubber meets the road.
And the forward guidance was highly bullish. It completely supported that stock reaction. Management raised their full year FY26 revenue guidance to between $56 and $60 million. And crucially, they also raised the FY26 adjusted EBITDA target to a range of $4.5 million to $6 million. This implies continued aggressive margin expansion through the rest of the year, driven almost entirely by that AI ad tech stack.
I mean, that's exciting, but a balanced view has to acknowledge the risks. Did management say anything to counterbalance that optimism?
They did. They were transparent. They cited two main constraints. One, the expectation of continued GAAP net losses in the short term, and two, that modest cash balance we talked about earlier.
So they're betting on growth to get them to profitability before they need to raise cash.
That's the bet, that the operating leverage and revenue growth are strong enough to let them scale into that profitability without needing to raise capital right away.
And they do have the industry context supporting that bet. The podcast ad market is looking much better than it did a year ago.
Much better. The U.S. market is rebounding. It's projected to grow around 26% this year. The global market is even more aggressive, expected to grow at a, 27% plus compound annual rate through 2030.
And that growth is driven by better ad tech.
It's driven by better monetization through ad tech and AI targeting, which is, it's a perfect validation of PodcastOne's whole strategy around Flightpath and Booster.
So if we look at the immediate investor context, how did the market validate this whole idea of a transition from a story stock to a real operator?
The validation was swift and it was heavy. The stock closed up 6.7% on the day of the call, settling right near its intraday high of $2.43. But the real tell is the volume.
The volume.
Roughly 176,000 shares traded hands. Typical volume is less than 10,000 shares. So the market just decisively voted that this earnings print was a major catalyst.
And this outperformance, it's not just a one-day thing, right? It's part of a broader trend.
That's right. When you benchmark PODC against the general market, like the S&P 500 or the communications ETF, XLC, it has materially outperformed over the last 1 and 3 months. We're talking gains of over 34% and 44%.
So investors were getting positioned ahead of this.
It seems that way, yeah. They were anticipating this operational pivot.
And what about institutional confidence? Are we seeing any insider or analyst activity?
Sentiment is strongly bullish. The small analyst consensus targets are clustered right around $3.30 to $3.40, which implies pretty significant upside. And then we saw a critical sign of management confidence right after the call.
Insider buying.
Insider buying. Director Merriman purchased about 10,700 shares shortly after the print. And, when insiders put their own capital on the line, it really reinforces the belief that the stock is undervalued relative to the new guidance.
So we have this conflict. An aggressive management story, high growth, raised guidance, insider buying, all of it housed inside a micro-cap valuation that maybe hasn't fully digested the implications of this AI-driven leverage.
That's the narrative tension right there. Traders are now weighing that execution risk against what is now a clearly defined path to profitability. The stock's modest consolidation after that spike suggests that balance is being struck, but the foundation for scaling is now in place.
Now, we must talk about what this means for valuation going forward. The following discussion is purely an analysis of the market's high-conviction bullish case and should not be considered financial advice. We are analyzing the rationale built around that raised guidance.
Right. So the question becomes, given this pivot and the strong tailwinds, are those analyst targets of $3.40 realistic, or is it just hype?
Well, the argument for that higher valuation is pretty compelling, and it's rooted in the data points we just discussed. The stock historically shows a strong post-earnings drift, a pattern that often leads to upside. But the crucial difference this time is that raised guidance.
Especially that $4.5 million to $6.0 million adjusted EBITDA range.
Exactly.
That range just fundamentally validates their ability to scale. You have zero debt, which makes that EBITDA incredibly clean cash generation. You couple that with the Podroll platform spiking 71% year over year, and you realize they've hit a clear inflection point. And the insider buying just confirms management thinks this value dislocation is going to close and probably close quickly.
So the bullish case here is that the recent consolidation is just a pause before the stock makes a run toward that analyst target range. It's high risk, high reward, betting entirely on them executing this AI-enhanced monetization strategy over the next, say, 4 to 6 quarters.
To recap the core story here, PodcastOne leveraged a proprietary AI stack Flightpath to optimize pricing, Booster to automate operations, to completely transform its content distribution and monetization. This Q2 print wasn't just a beat. It marks the decisive step from being a speculative story stock to a potential scaled operator that's demonstrating real, sustained financial leverage.
That momentum is undeniable. But as we close this deep dive, here's a final provocative thought for you to consider. Given how much they rely on these key centralized monetization deals, I'm talking about that $20 million plus Amazon Art19 run rate and the $26 million plus Fortune 250 streamer deal. What are the long-term implications if one of those massive partnerships were to suddenly soften or change direction or even introduce competition? What level of diversification is necessary to sustain this pure play growth in the face of such highly centralized revenue? Something to mull over as you watch this space.